Hi, Greg Weldon here with another episode of Money, Markets, and New Age Investing. And we have a lot in terms of money tonight, all right? Because I've done a couple of recent research pieces for my institutional and retail individual investor client base. And I think that the two titles that I've used since last week really apply here, and I'm not even decided yet which title I'm going to use for tonight's podcast. But bottom line is, number one, last week when the Fed met, Jerome Powell, the press conference, it might be the least important press conference in the history of the Fed because the banking situation kind of has defined now how far the Fed might be able to go. And, the markets are clearly saying the Fed's done. All right. So it didn't matter what Jerome Powell was going to say because, in the wake of a semi-serious banking crisis, that he can't really talk hawkishly. All right, he has to play both sides of the coin. So from that perspective, it didn't matter what Jerome Powell said. The markets were already reacting to the fact that the Fed had to print a whole bunch more money to bail out a bank. It's that simple. And the title of my piece last week on the Fed was "The Fed Pouring Ether on the Fire." We know that ether is actually a flammable chemical, floats on water. New rage down here in Florida is to have ether fire parties. You got this ether fire in the pool, and it's pretty cool, right? But, of course, the same time, pouring ether on the fire and this whole situation speaks volumes towards the benefits of owning some crypto, I call them commodities, which specifically ether, Ethereum, and Bitcoin. All right. Now, we'll talk more about that later. The risks, the rewards, the differences, and why we like both, so on and so forth. But it was pouring ether on the fire because the Fed's all this hawkishness and all this, we got tightening on monetary policy, and they go out and print, $400 billion with the Treasury. Wink, wink. So that just blew out any thought process around the Fed's going to keep tightening to defeat inflation. They are acquiescing to higher general levels of inflation going forward. And that's a big part of the argument we're going to have in part two when we talk about the markets. The second title that I used yesterday, the treasure of the Sierra Madre. We don't need no stinking badges. And if just to verify that I know, to clarify that I know, that you know, that I know that you know, that's a misquoted line. It was basically, that's not the exact line. That's been kind of, edited over the years to where that is the famous quote that is actually never a quote in the movie. It says, "We don't have to show you any badges." And then something about stinking badges later. So they combine the lines because, of course, it's a great line. We don't need no stinking badges. Well, in this case, the thought process and theme behind the piece was, you don't need no stinking badges to hijack the burros here carrying the gold down from the mountain. All right. You can easily participate in this new era gold rush, which is kicked off already. All right. So we'll talk more about that too. But it comes back to that the markets are finally coming to, you say, well, why did the fixed income market react so dramatically to the point where the end of next year's Fed funds forward rate got down to 275, which meant the Fed would be cutting rates by like 200 basis points between now and the end of next year. Now, we'll talk more about that later too, because the economic data kind of supports that to some degree. But staying on point for where we are now, it's a realization, an epiphany, a all of a sudden wake-up moment, light bulb over the head on the numbers, the sheer size of the numbers and some of the real cracks in everything out there, and the heightened risk as these numbers go exponentially higher. The risk goes up. Of course it does, because you have to print exponentially more money every time. We see that. I've been doing this since 1984. I've seen this entire cycle. 287, to 1990, through 97, 98. You had the crisis in the Asian currencies, then Russia, and then Brazil, and then you had long-term capital. Then 2000, the tech bubble burst. Then 2008 and 9, of course, the crisis and the pandemic. I've been through every single one of them. Even the degree to which I went through the 70s as a kid, as a teenager, I remember a lot of what happened. People losing their jobs. One of my best friends' dad was a stockbroker, and he lost his job, and he ended up delivering 7-Up in a truck for the rest of his life. I mean, it was vicious. But it's a realization of the numbers where we gotten now, because back then, I did a piece not too long ago that laid out the 1978 testimony by Paul Volcker about inflation. And it's the same words that Jerome Powell is using because he's a student of Volcker. And we might have talked about that in the last podcast, I'm not sure. But the point here is, back then, you had no debt. The numbers were totally manageable because you had only just started kind of this thought process around the gold window is closed. We have seigniorage won in World War II, and we're going to print as much money as we want because we can borrow as much money as we want because the dollar is the means of transactions in trade around the world, mostly for natural resources. The petrodollar, of course, plays into that. All right. So back then, starting in the 80s, you could print a lot of money. That's how Reagan, revolutionized kind of the country back into greed is good all of a sudden. And that was 1987, which I lived through and made a lot of money in 87. But in the context of where we are now, 17 trillion in deposits. And if you take the totality of deposits and include some other things that are deposits, it's over 19 trillion. So let's call it 20 trillion in deposits against 0.128 trillion in FDIC coverage. It's 128 billion, okay, that the FDIC has in the Deposit Insurance Fund, the DIF, against 19 point something, I think it's 0.3 trillion in deposits of all kinds. We're starting to see the problem here. You can't cover 19 trillion in deposits. There's no way, man. And to even float that idea is the argument that gold should be at $4,000. It's pouring ether on the fire, all right? 15 trillion, it's actually a little bit more than that now in public pensions. The total pension liabilities going forward, kind of, you want to call them uncovered liabilities, is 26 point something trillion dollars. Public debt is $32 trillion. We're talking big numbers. And the Fed, all right, their balance sheet, it peaked at 8.9 trillion March of last year. So it's almost it's like exactly a year. It's a year and 7 days to today. That the week of the date that the Fed's balance sheet peaked at almost 9 trillion. All right. Now that's up from 3.8 trillion in 2019 when it hit a low when they were completing basically 5 years of shrinkage. Okay. So if we go back then, we can see that the ad here, all right, the pandemic ad from 2019 to the peak was $5.16 trillion. The ad during the 2008-2009 crisis, which continued from QE1, QE2, QE3, TARP, TAF, QE by Japan, QE by Europe, all right, but the Fed's balance sheet from 2008 to its peak in 2015, the ad was 3.8. 5.2 now, 3.8 then, all right? Of course, this was, a much shorter time frame too. And you got only 12% of that was actually wielded off by the Fed. It took them a year, all right? They took the balance sheet down by $620 billion out of a $5 trillion ad. And in 2 weeks, they unwound 63% of that. All right. So they added 391 billion back. So, the balance sheet is not that far from a record high. They're supposed to be shrinking. It's supposed to be QT. It's not happening anymore. And that's really the crux of the matter, and where the markets have suddenly woke up to the fact that the numbers are absolutely, positively mind-blowing, let alone the public debt, most of which is borrowing from the public. And that's a reliance that the Treasury has had on financing the debt. Public debt is, what is the number? 31 point something. I forget off the top of my head. But it's sizable. It's 31.6 or 7 trillion dollars. All right. We look at the ad, all right, in the most recent 12-month period. All right. It's the 13th largest ever. And by the way, let me go back, because the single week increase in the Fed's balance sheet. Let me just finish this thought. The single week ad in the Fed's balance sheet of the peak was 294 billion in a single year. 297 billion in a single week, was the fourth largest ever. And it is only the fourth because of 3 pandemic periods. And I'm talking about a single week. All right. Because during the pandemic, you had a week of 586 billion, 557 billion, and then 356 billion. All right. So you had a huge amount during those 3 weeks, much bigger than we've had in the last 3 weeks. But the point is, in a single week, the most recent printing of money by the Treasury and addition to the balance sheet by the Fed, monetizing debt of 297 billion. Okay, the week ending the 15th of March, ranks as the fourth largest behind the pandemic and far larger than the largest during the crisis 2008-2009, which was March of 2008 when it was 179 billion. They added almost twice as much, not quite, but over 120 billion more than the peak of the 2008-2009 crisis in 1 week. It's a massive it is, again, it's the fourth largest ever, only behind 3 weeks in the pandemic that the Fed just pumped out money. And you're talking about just the gain in the public debt year over year. I mean, it's 1.8 trillion, right, in the most recent 12-month period. That is, we've become so immune to these numbers, 1.8 trillion, and you're kind of like, well, that's small. It's only the 13th largest because in 2021, you had, year-over-year numbers of 4.5, 4.2, 4.4. Even through 2022, 2.4, 2.039, 2.2, 2.052, and now you're down to 1.8. So it's like, well, this is a vast improvement. It's like the highest ever before the pandemic. So again, these numbers are mind-blowing in terms of the debt creation, in terms of the QE that's already taken place here, and in terms of what might have to come next. And then you start to talk about the economy. I mean, the fact that the economy is in a situation where, again, I just did another piece on the economy, and I called it Down. And that's a song title from one of my favorite all-time bands, Stone Temple Pilots, Scott Weiland. All right. And the degree to which Down just fed in terms of some of the words, it takes more than a breakdown. It takes a meltdown to show us how. And this is kind of like people are sitting here saying, is there a recession? I mean, man, the data says we're there already. And some of the data, doesn't, and some of it does. Of course, it's polarized like everything else. But in terms of the data we just got, the data I just wrote about this week already, Richmond and Dallas Fed surveys. This is the Fed's own material. All right. In the Richmond Fed, the manufacturing sector, understanding the service sector is a much larger proportion of the economy, but that's going to be key in the next phase of comments. Because the manufacturing sector, the only time that the Richmond and Dallas Fed manufacturing services have been this bad in terms of the readings, headline activity, new orders, order books, backlogs, all these kinds of things in terms of the flow, the pipeline of the economy, are the worst they've been. First of all, you got 11 consecutive months in negative territory, 11 consecutive months of contraction. That's the title. Down, economy going down. Manufacturing for sure, employment already contracting now. All right. The only other times it's been this bad, 2000, tech bubble crash, 2008, global financial crisis, 2020 pandemic, and now. Think about that. Those 3 times and now. And we're debating whether the economy's in a recession. We say, well, hey, Greg, the manufacturing, who cares? All right. Well, I know I care because to me everything matters. But I rebut it by saying the service sector is now into the same phase. It is starting the same track that the manufacturing economy started 11 months ago. The service sector numbers from Richmond, it was an utter collapse in the numbers. You talk about even retail. There was some increase in retail sentiment, but the degree to which price increases still are keeping consumers at bay, I think probably one of the more important numbers, if you want to take it from service, which was awful. The numbers were terrible. I mean, again, even though, 1 month doesn't make a trend, it's some of the worst numbers we've ever seen outside of times when it was a recession. And then you turn to the consumer, because isn't that really what it's all about? It's about service sector as per consumer spending. Well, First of all, I'll mention that during the recent dynamics around the banks, we've had the first ever decline in deposits in the U.S. We have not seen this in this entire cycle since 1971 when the dollar was taken off the gold standard. August of 71 is when all of this started. And I'm not saying go back to the gold standard. Gold would have to be something I did the math for a recent conference. If you wanted to go back to the gold standard, gold would have to be priced at like $60,000 an ounce to cover every dollar, and I'm sure it's much higher. All right, I mean, you could, depending on what money supply you use. All right, and I did them all. I mean, a reasonable one was $60,000 if you covered like something like 25% of all, all IOUs. All right. Of course, it's ridiculous. It's not happening. But we tracked this credit bubble from them because that's when the U.S. could start doing IOUs all they want. All right. And man, we are not more intense in that right now than ever. I don't understand. But to get back to kind of the question here is, it comes back to the consumer. And when you look at the consumer, the Red Book retail sales numbers is a really good data series. And it has been very strong. It has reflected a consumer that has been stronger than some of the other numbers would suggest. And I've been one that has been panning the consumer for a while, saying consumer cocoon is coming. And it is here. And it is hardening. And the degree to which you have seen a dramatic fall off in sales during March is kind of mind-blowing. A dramatic decline like we've never seen before in this era since 1971 in bank deposits. $400 billion. I mean, it's sizable, it's unprecedented, and the charts are mind-blowing. Now, you would say, well, yes, that was a big bulge in deposits thanks to all the money printing during the pandemic. $5 trillion dollars printed, $3 trillion ended up in the banking system as deposits. It doesn't matter. It doesn't matter. People have withdrawn their money from banks like crazy here, man. So to whatever degree the FDIC can't bail out all these deposits is interesting. And that gets back to the consumer. So you have this dynamic where you have an unprecedented decline in bank deposits at a time when you just cut in half and in dramatic fashion. Again, the chart really dramatic in the year-over-year rate of retail sales to a level that's so far below inflation. Again, this is value of sales, not volume. So you're talking about if you were at 2.8% in year-over-year growth in retail sales and inflation 6%, guess what? Okay, the volume of stuff being bought is lower. All right, lower. Down. Again, I used a lot of STP lyrics. There's so many good songs. It's like kind of I am the cracker man. I crack open the data. I show you where the cracks are. I mean, it really is. And I'd love to be able to, turn it the other way and show you where all the growth is. But in this case, this is about seeing what's coming next. And it doesn't look pretty to me in terms of the economy and the stock market being really actually kind of out of touch with the reality of the economic situation, is interesting to me. But, it's tough to sell the stock market short right here because of two things. Number one, the dollar. And number two, what the forward fixed income market shows you. So, turning to that, the fixed income market, because of what happened here with the bank situation, all right, you priced in a lot of rate cuts by the Fed now. I mean, the fixed income market had kind of slowed its, hawkish, it had lessened its hawkishness maybe, 6 months ago. The dollar peaked in August. All right, it had another kind of run up in October, but it's been down ever since, the dollar. All right, but we'll get to the dollar in a minute because it sets up by fixed income because the dollar rally was predicated upon the movement in the forward Fed funds that, basically came before the Fed even began to hike rates. They were late to the party. The market was already there. The word transitory had already been, dismissed as a total lack of credibility for quite a long time, and I've talked about that at length in the past. The 2-year note got as low as 385. It's around 410 right now. I didn't check this morning before I started. It's like 6 o'clock in the morning. I was going to do this last night, but I ran out of steam. It just, in terms of publishing, takes a lot. And we do it daily. I do a daily half hour for my customers. 20 minutes, 18 to 20 minutes. The 2-year note got down to 385. The end of next year's Fed funds got to 275, and it's lasted 330. The Fed funds rates, let's call it 5, all right, at the top end. I mean, you're talking about pricing in 150 to 175 basis points of rate cuts in the next, 20 months, 19 to 20 months. That's a lot of rate cuts when the Fed has told you we want to get to a point of being restrictive and then we want to stay there for some period of time to make sure inflation doesn't come back. But can they do that now? I mean, you can't bail out 17, 19 trillion in deposits. You don't have the money. So you have a situation where the front end of the curve now is like pricing in easing, and it's a lot. And it's kind of expensive here because that's a lot to already price in, right? Now the Fed could get restrictive by doing nothing here because inflation is probably going to fall below 5. And all of a sudden the Fed will have a Fed funds rate above the rate of inflation. That will be slightly restrictive. The question is, how long are they going to stay there? They have stayed too long on transitory. They have stayed too long here in the fact that, if they started earlier, they could have been ending by now, and we might not be in this dour situation going forward. Either way, it doesn't matter because they're going to do what they're going to do, and actually Powell has done everything he has told us he would do. He said in 2018, in 300-plus pages, in 11 different white papers, the Fed laid out their new policy protocols that said we will allow inflation to get above average. We are not even going to give a tolerance band. In other words, we don't care how high it goes. All right, we have no tolerance band. In other words, we'll let it get to 6, but we won't tolerate anything above that. It's called a tolerance band. They did away with that. What was going to be the average? They were going to use the longest term 8-year average because it was the lowest and would give us the most room for upside push in inflation. And they said we will let it stay there because we know how to bring it down by raising rates. The problem, I think, with Powell is he's looking at Volcker. He's looking at a time in the 70s and 80s when there wasn't this much debt. You can't do that with this much debt. It changes everything. And that's what I think the Powell, and I love the guy. I mean, how can you not like Jerome Powell? He just seems like a friendly, gentle soul, like a good guy. He just seems that way. He's not one of these, talking heads that just wants to, if you can't dazzle him with brilliance, confuse him with bullshit, right? So the dynamic to which he's told us exactly what he's going to do, and he would do draconian Volcker-like interest rate hikes to bring inflation down. That's what he's doing now. He's done everything he's going to told us he's going to do since 2018. He's been the most transparent and the most on point in his own mind Fed governor we've seen in a long time. Problem is, there's cracks in his argument. The biggest one being, this isn't the 70s, man. We don't have the situation with no debt in the backdrop that we had in the 70s. Anyway, moving forward from that, the curve starting to flatten, all right, the 30 to 5 years back into positive territory. I think what this is saying is, okay, if the Fed funds market is right, and you're going to cut rates to 275, let's say you're going to cut them to 3.5. That's 150 basis points of rate cuts. That means you're acquiescing to a higher level of inflation, and that's why the 2-year note is still above 4. The 2-year note should be more in line with the 2-year Fed funds forward, and it isn't. And we've seen this before on both ways. And it always is a tell. And it's a tell here that the market is preparing for the thought process that when the Fed changes their narrative, it is going to open the door to basically saying they're acquiescing to a generally higher level of inflation. And that's exactly what it's saying. That's why the curve's beginning to flatten, because the long end will bear the brunt of that. The long end will bear the brunt of a really mismatched supply-demand situation in the bond market. All right, again, let's not forget, central banks could lose control of bond markets here anytime, which would cause them to have to print a lot more money. And it'll happen. It's just a question of when and how much will they print. Will they print enough? But they're going to do it. And the reaction we just saw in the markets tells us what we need to do, because that's always been the game plan. Always been the game plan. For the short end, and for all this to kind of where you really see this kick in, I watched the SHY, which is the 1 to 3 year Treasury Bond ETF. 82.75 is the price high. You get above that level, it suggests curve flattening is coming and that the market is right and the Fed's going to be cutting rates. We'll keep an eye on that. So this leads to the dollar, because the dollar is, of course, the king in terms of commodity pricing. And that's where we're going with all this. Precious metals, Treasury Sierra Madre, and pouring ether on the fire, crypto. The dollar, okay, all of the medium-term momentum indicators for the dollar are negative, bearish right now, outright bearish. The year-over-year rate is still minor positive, around plus 4% year-over-year, but that's going to roll off fast because the dollar started rallying really sharply in the spring of last year when the Fed started raising rates. So you're going to see a massive reversal in the dollar's year-over-year rate of change, which matters. All right, but even more important would be if par 82 in the dollar index, the U.S. dollar index, par 82 was violated. That's a major low. You've had the big decline to that low. You've had a perfect Fibonacci moving average dynamic correction to the upside. It's textbook analysis, tech analysis 101. You could play this through the dollar down ETF, which is the UDN, dollar down. 1898 is the high that equates to the par 82 low in the dollar index. I believe that level will be taken out imminently, and the dollar will be into a fairly significant decline. The thing about it is, it already is in a significant decline. It's in a significant decline against the price of gold. I watched what I call the gold adjusted value of the dollar. The gold adjusted value of the dollar is very simply the dollar index divided by gold. How much gold does a dollar buy, and then what is the value of the dollar relative to gold? It's just the flip side of the price of gold. But it really tells you something about monetary conditions, and it has been spot on. Seeing the tightening in conditions coming and then the reversal. And it was reversal fast because the dollar peaked long before the fixed income market even moved to begin pricing in any kind of easing. The gold adjusted value of the dollar is up only 1.4% year over year, much less than the 4% on the flat dollar. Tells you how good gold's performed in the face of a strong dollar. Everyone criticizes gold. Performance in gold has been phenomenal, and it's not down a lot more at the lows than it had been. The uptrend line since 2020 in the gold adjusted dollar has been violated. I watched this I am so hyped on this and very much tuned into this because it's been a great indicator over the years. It really has. It just doesn't fail you. The monthly chart, I watched the 2-year, 5-year, and 10-year moving averages. This is the big picture dynamic around gold and the dollar. Right now, it turned bullish for gold in June of 2019. That's when gold first took out 1365, which was the major overhead resistance, and we got long at like 1380. You went through a period when the Fed was tightening where the differential between the 2-year and the 5-year moving average began to narrow. Still aligned to the downside for the dollar, meaning upside for gold, but began to narrow their differential. All right, that began to re-widen, meaning bearish on the dollar, bullish on gold in December. Just recently, December 1st, and gold was at 1803. So you can see gold's already 1965. I mean, you're up big from there already. All right. So the point here is the dollar down is really key to all this because it plays off the Fed, it plays off the fixed income markets, the forward markets, and it's all reacting to the fact that the Fed is so quick to print $300 billion, and the Fed and Treasury, of course, to the degree that the Treasury prints it, the Fed uses it to buy bonds, monetizes debt, and pumps that money into the system. So what about the precious metals? Gold's at 1969 last. 1966 was the previous monthly closing high. So if by Friday you're still above 1966, it will be a new all-time high in gold on a monthly close-only basis. All right. The GLD would be the ETF for gold. 184.83 is the high. 182.53 is last. You're not quite there, and that's the monthly closing high. Similar dynamic. Bottom line is gold's already on its move. All right. Silver is more recently coming to the party here. All right. The big level on silver has always been 24.77. Last at 23.86, you're about $1 away, 90 cents or so, 88 cents. The 61% retracement was hit on the downside. And frankly, silver looked really crappy there for a while, but it held right where it had to, man. Any worse and silver would have cracked. It didn't. And it held right where it needed to. Open interest in silver is like the lowest it's been in a long, long time. Same with gold. No one owns this stuff, man. Everyone's afraid of it because it went down only 10% when the dollar was up 20. Come on, man. That's phenomenal performance. It really is. All right. Silver, in that case, did have its downside, and that's really kept people out of the silver market. No one's involved, and it's time to be involved. I added to my position actually before I started this podcast, and that's not front running. I'm just telling you what we do. What we do as a fiduciary for my money management clients is the most important thing. I'm now telling you that just so you know. I'm not pumping up silver here on the podcast, to benefit myself. I don't need that. I don't need you guys being involved in silver for us to benefit. This is so much bigger than that. So just to make that clear, because gosh, I would never, my ethics are beyond reproach, man. That's the only way I can do this as myself, is to always do the right thing, to have everything as transparent as possible. The money management business is clean as a whistle. The NFA is, all over us on that. And so to whatever degree, when we look at this, it's just an opportunity. It's just, again, the treasure of Sierra Madre. We don't need no stinking badges to participate. All right. You don't need no stinking badges. I need the badge. I got the badge. You don't need the badge. The SIL. Now the mining shares come into play. And that was yesterday's piece. And I'm going to tell you in a minute. We're going to wrap this up soon. Don't like it to be too much longer than a half an hour. But I have a great offer for you at the end here of some printed material that I'm happy to send you. All right. But the SIL, 3190 would be a breakout. That's the downtrend line. The moving averages, oscillators, all would be positive. SIL, the silver mining share, 3190 breakout. GDX, the gold mining share ETF, 3334. Last at 3204. All right. 4160 is a big breakout, but you're within $1.30 of a major breakout to the upside. And guess what? Gold, the price of gold versus the U.S. stock market has outperformed by 17% over the last 52 weeks. Gold and silver and the individual shares, which I dissected at length in yesterday's presentation of my clients, is one of the things I'm going to offer you in about 2 minutes. Crypto, commodities. They're commodities. I hate cryptocurrency. It's not a currency, all right? It's just not. It's the wrong way to think. And you want to make it even more suspect. You say it's not gold and it's not a currency, but you use a gold coin with a $B sign as your logo. Come on, man. Come on, man. Come on, man. But anyway, it has value, all right? To think it doesn't is to be naive and short-sighted and closed-minded, all right? And frankly, if you have $17, $19 trillion worth of deposits and people want to get their money out, which they have actually started to do on a scale we've never seen before, ever. I'm telling you, the charts are mind-blowing, and I'm going to offer them to you. But in that context, it's much easier for people to just go on their phone and put it in their electronic wallet because you're going to move it to another bank. You're going to go get cash and bring it home, put it in your mattress. You're going to go get cash, go to the bullion dealer, buy bullion and come and hold it in your house. It's much more likely that a large portion of the population, certainly of some age demographic, would be very quick to have an electronic wallet, boom, put a whole bunch of Bitcoin and Ether into it as a way to withdraw deposits from the banking system. It's going to happen so fast, it's not even funny, which is why they're scared to death of that. They couldn't be able to they wouldn't be able to freaking handle it. So in that case, I don't think it gets to that point. I don't. It shouldn't, not now anyway, someday. But a lot more has to happen. Dollar card has to be played by the Chinese first, and that's still steps away. But in the case of crypto, Bitcoin, all right, it's the highest since last spring. It just got above the 2-year exponential moving average. I'm watching the futures contract. I know it trades at a premium sometime. I don't care, all right? It is the market. It's what it is, all right? You trade it for what it is. I actually like Ethereum better, all right? It needs to get above 2022. The last is 1748 is the daily. I'm sorry, I'm talking about the 2022 high was 2017. The latest kind of daily breakout would be 1748. So last at, I think it was 1805 last. But you have the 52-week moving average above it. Ethereum is up 34% over the last 6 months. And Bitcoin and Ethereum are both outperforming the S&P 500, the U.S. stock market over the last 52 weeks. Get this. Bitcoin against the S&P 500 as of this morning is up 42.9%. You earn 42.9% more owning Bitcoin than the stock market right now in the U.S. over the last 52 weeks. For Ethereum, it's 27.2% over the last 52 weeks. They are actually outperforming gold, which is up 17%, but I think that's about to change because I think gold's about to take off, silver's about to take off, the mining shares are about to take off. And on that front, I want to offer you kind of a compilation of recent lives that have all the stuff I just talked to you about, including my rundown of the individual mining shares, gold and silver mining shares. What are the top picks here? I'm going to show you all of this. And, we run a business like this, but this is not about running the business. This is about helping people, all right? Hey, if we get clients from that, that's great. Everyone's happy. They'll be happy for sure. I'll be happy for sure. But that's not why we're doing this. I'm doing this to put something in front of you that's going to help you, that's going to put something in front of you that's tangible, that has value, all right, than just me talking. When you see the charts, it's more imprinted in your brain. I'm big on visuals for the conferences I do. I'm speaking at a conference, by the way, in South Carolina at the end of April. We can get details on that if anyone cares. Email sales@weldononline.com. That's WELDON online, one word, weldononline.com, sales@weldononline.com. I will send you a PDF that's going to blow your mind. All right. And in that, by the way, in yesterday's live, we looked at Forbes, just ran an article on the top gold stocks for 2023. Forbes Advisory, great, old school, highly respected, still relevant, really great stuff. And I'm going to play off my stocks against Forbes stocks. And frankly, when you pick solid long-term earning stocks that are uptrending, that have had little downside, don't have a lot of volatility, but they're trading at $150 a share, you know how much money has to come in for that to double? Versus a stock like Kinross that's less than $5 a share, or a whole bunch like Sabina Silver. I mean, holy mackerel. You're talking about call options on this stuff with no expiration date, no time decay, that you can hold forever and pay a premium to own them, $3, $4, $5. The case of Sabina Silver, SBB, it's $2. All right, it's one we love since literally since 98 cents. And I don't play penny stocks. I don't. But, in this case, it's a simple call option way. There's a host of the mining shares that look really good here. Some have already broken out, already on the run. You can't wait. Email me, sales@welldononline.com, and I will send you a PDF that I think you will appreciate, number one. And number two, thanks for listening.